Broadcom reported quarterly financial results that sent the stock price soaring. Of course, Broadcom has been one of the better performing stock prices this year. It's already up significantly, and the most recently completed quarter was yet another data point showing why investors are so excited about this business that's benefiting so significantly from the rising effectiveness of artificial intelligence. In this video, I'll review the company's latest quarterly financial results, and I'll share with you my updated proprietary discounted cash flow valuation model, which I had to revise significantly upward given what the company reported on in this latest quarter, which included a $10 billion sale to a new customer that it looks like is OpenAI, with ChatGPT making a big $10 billion purchase commitment for Broadcom's products and services, and that will boost the company's earnings and cash flow starting next year. So big positive developments for Broadcom, which created the need for me to revise upward my fair value cap calculation for Broadcom stock. I'll share that with you in this video. I'll also share with you my recommendation, whether I think the stock is a buy or whether I think it's a good time for investors to take profits for Broadcom stock, which is already up so much this year. That's a lot to cover in a relatively short video. So let's jump right into it following this brief message from my sponsor.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So Broadcom in its quarter reported $15.9 billion in revenue, and that was up 22% from the same time last year. Of course, anytime you have a company reporting 20% revenue growth, that's also generating adjusted EBITDA margins that exceeded 67%. That's going to create a lot of excitement for investors. In fact, adjusted EBITDA came in at $10.7 billion for Q3, and that was at 67% of revenue. Broadcom has consistently reported great profit margins, and this recently completed quarter was yet another point of evidence suggesting that this is a very well-run company with great profit margins. Cash flow from operations of $7.166 billion, minus capital expenditures of $142 million, resulted in $7 billion of free cash flow, and that's 44% of revenue. This is a very asset-light business model. Remember, Broadcom doesn't do any of the manufacturing in-house. It outsources these activities, and so it's primarily a semiconductor design company. And these companies, this is what NVIDIA does also. It's a semiconductor design company, which allows the company to generate strong free cash flow because it doesn't need to reinvest consistently into manufacturing capabilities and manufacturing technology and manufacturing expansion. It leaves that to other companies. And this is a very capital intensive part of the semiconductor industry, the manufacturing. But the improvements in manufacturing capabilities from companies like Taiwan Semiconductor Manufacturing allow companies like Broadcom, AMD, and NVIDIA to focus primarily on the design part of the business and outsource the manufacturing to those companies. Broadcom is forecasting the good times to continue with Q4 revenue guidance of $17.4 billion. That would be an increase of 24%, which would be an acceleration from the current quarter 22%. So I talk about that second derivative, accelerating revenue growth. Broadcom is delivering that, to be sure. Fourth quarter adjusted EBITDA also expected to remain elevated at 67% of revenue. The management team said that Q3 AI revenue growth accelerated to 63% to $5.2 billion, and the company saying that they expect growth in AI semiconductor revenue to accelerate to $6.2 billion in Q4, delivering 11 consecutive quarters of growth as their customers continue to strongly invest. And I've been talking about AI stocks for a couple of years now, and it seems like every quarter I repeat myself and say that this is not a fad. This is something that businesses continue to invest aggressively and, in fact, increase their investments across the board. And this is yet another point of evidence where we can be more confident in this artificial intelligence boom. Enterprises and governments worldwide continue investing. Consumers, enterprises, and governments are consuming artificial intelligence at an increasing pace, right? OpenAI said that ChatGPT is now approaching 1 billion monthly active users, and the engagement among those users is increasing as well. So this is something that's not going away. It's actually increasing, and that gives me more confidence in other AI stocks that I've rated as a buy and that I own, companies like Nvidia and Alphabet that are in my portfolio. I'm gaining more conviction with because of the adoption and increase in investment of artificial intelligence. The cash flow from operations number for Q3 at 7.166 billion was up by 2.2 billion from the same quarter last year, where it was at 4.963 billion. So excellent growth in both revenue, profitability, and free cash flow. Broadcom used some of its free cash flow to pay down debt. It now has 62.8 billion in long-term debt, which is a large number. Some of that is a result of the acquisitions that Broadcom makes, and most recently it acquired VMware, and that acquisition is working well for Broadcom. I maybe unfairly, but I always compare Broadcom to Salesforce because Broadcom has made several effective acquisitions, paying prudent prices for those acquisitions that have worked really well. Whereas Salesforce, I've kind of not been thrilled with the acquisitions and the prices that management pays for their acquisitions. So when you have a company that's growing as well as Broadcom is growing, the share price, the stock price tends to increase more when that company also has a lot of debt because more of that business is financed through debt, which creates more value for shareholders when the business booms. So during good times, a company with a lot of debt actually benefits more than a company with zero debt when business is booming. That's one of the benefits of expanding or funding your expansions with debt. Of course, the downside is also magnified when things don't work well when you have debt. So having debt on your balance sheet magnifies or multiplies the directional movement. So when the directional movement is positive, as it has been for Broadcom, having a large having a large debt balance magnifies or multiplies that improvement. And this is also the case for Oracle, which has been one of the stocks I had rated as one of the best stocks to buy this year. Oracle's positive performance was multiplied by the fact that the company is financed with a lot of debt. Broadcom, similar in that regard, but the company's management using some of that performance improvement to pay down debt. It reduced the debt balance by roughly 4 billion. All right, so let me share with you my updated proprietary cash flow and the intrinsic value. Before the company reported these quarterly results, I had the intrinsic value per share at around $142, $145. After these quarterly results and the revealing of that big new customer in OpenAI with the $10 billion order, I revised upward some of my free cash flow expectations over the next few years. I also revised upward the company's longer term free cash flow expectations, which resulted in a big increase in the intrinsic value per share to $211. But even after that big revision upward, it's still trading at a price that's well above the intrinsic value. The current market price at 334 is well above the intrinsic value of 211. Now, when I go to fiscal.ai, which is my preferred data provider, and I retrieve the company's forward price to earnings ratio, it also looks expensive in this regard. It's trading at a forward PE of 41, but this is more deserved because now this company is growing revenue north of 20% with adjusted EBITDA margins north of 60%. So premium valuation for this business is deserved, in my opinion. So a forward PE of 41, even though it's the most expensive this stock has traded for going all the way back to January of 2024, is deserved because the business is performing to justify this kind of valuation. However, when combining the proprietary DCF valuation with the forward PE valuation, the stock price looks a little stretched. So if you're asking me if I think this stock is a buy, hold, or a sell, I rate this stock as a hold. I would look for a better price to buy this business, and I am interested in buying this business, but I would want to buy it at a better valuation. So I have it rated as a hold as of September 5th, 2025, after accounting for all of the positives from the latest quarterly financial update. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.